Meantime, shares of Alphabet falling after reporting Q4 results just moments ago. Joining us to dig through those numbers and tell us what to do with the stock, Ali Mogharabi, analyst at Morningstar, has a hold rating on that stock. Brent Thill, Jefferies analyst. Brent has a buy rating on Alphabet. Brent, already the shares are coming back from the worst levels after hours. Looks like a slight revenue miss. They break out cloud and YouTube. What stands out to you?
Yeah, I think the added transparency, the stock would be lower given the revenue miss if they didn't have more transparency. And this has been the single biggest thing tech investors have been pushing Google for. So to get a YouTube number, to get the cloud number, and then also they bought $7 billion of stock back. Remember, it's been their largest buyback ever. They have $20 billion left now on the buyback plan. So they're taking, there's inches now in terms of not gaining miles, but inches of becoming more shareholder friendly. And we think that is a very good thing for a stock that trades at 11 times EBITDA. EBITDA grows 15. So they're significantly below their growth rate. And so we think this is a step in the right direction.
Ali, what do you make of the traffic acquisition costs and the operating margin?
Actually, we think both results were pretty positive. The traffic acquisition costs have stayed around 22% of overall ad revenue consistently for the last 4 quarters. So they're no longer facing that pressure. But however, we do recommend focusing a little bit more on the ad revenues, which came in below consensus, below estimates. And we think that there are a variety of reasons. The variety of reasons why the ad revenues have been impacted. One is probably GDPR, the impact of GDPR on these ad revenues. We saw something similar to that with Facebook, in our opinion. However, there are also some positive aspects to the revenues. The YouTube revenue was better than we had expected in our internal forecast, and also the cloud. I think the cloud is very positive. And in these days when Google is facing antitrust issues, focusing a lot on the online advertising side of the business, it's really good to see that their enterprise side of the business, cloud, performing very well.
Yeah, I mean, Brent, what did you think about those two? Did YouTube live up to Wall Street expectations? And cloud, I mean, we knew it was a distant third, right, to Microsoft and Amazon, but is it growing fast enough?
Everyone was guessing on YouTube. I mean, close to a $20 billion run rate makes a lot of sense. It's in the ballpark where most of us thought it would be. The cloud is, it's a rounding error relative to Amazon. They're 4 times larger on an annual run rate. And the Google number includes applications. Amazon's largely an infrastructure company. So that, the numbers are actually a lot smaller when you strip out the apps and make it like for like. I mean, Amazon is so far ahead. Again, if you add Microsoft and Google together, there's a $15 billion delta between where Amazon is at. I mean, it's like Patrick Mahomes versus the rest of the quarterbacks in the league. It's not even compare. So, Google's number 3, and they're doing great, but they need this additional transparency. And it reminds me of what happened with Microsoft when Ballmer left and Nadella took over. They're making the right moves. And again, this is the first glimpse. Again, I think we got a trifecta: cloud, YouTube, and the buyback moving up. That's great. There's still a lot of room they have to improve. Again, we like the stock at 11 times EBITDA.